This is the Strait of Hormuz, 33 kilometers wide at its narrowest point, and right now the most dangerous stretch of water on Earth for a commercial vessel. You'd think the ships still transiting it are being paid a fortune, but here's the secret. $400,000 a day isn't actually enough, because a single drone can turn a $300 million tanker into a total write-off in under 4 minutes, and most insurers have already stopped writing the policies that would pay out. Since late February, Iran and its proxies have struck more than a dozen merchant ships in and around Hormuz. Meanwhile, Brent crude has rocketed from $69 to above $110 a barrel in under a month. The invisible force quietly freezing the global tanker market isn't the missiles themselves, it's the war risk insurance market, which now holds the entire oil supply chain hostage. So why are some tanker companies posting record profits while their fleets sit completely motionless? And what happens to the global oil market when the last insurer pulls out entirely? To understand this, we have to start with an uncomfortable truth about how the world's most critical energy corridor actually works. Before March 2026, a VLCC, a very large crude carrier, running the Middle East to Asia route on a strong market could expect to earn between $80,000 and $100,000 per day. That was considered an excellent rate. Owners were happy. Charterers grumbled, but they paid. The math worked. Then the war with Iran escalated, and the math broke completely. By early March, spot rates for VLCC vessels had shattered every record on the books. Shipbrokers were reporting rates above $400,000 per day. One 15-year-old VLCC vessel, not a new ship or a flagship, was fixed at around $436,000 per day. Theoretical highs were being quoted close to $480,000 per day. Suezmax tankers, the mid-sized workhorses of the crude market, saw their earnings triple over a single weekend to above $260,000 per day on key routes. LNG carriers and product tankers were demanding six-figure day rates across Atlantic and European trades stressed by supply diversions. On paper, this was the golden age of tanker ownership. But here's where it gets complicated, because sitting alongside those record rate headlines is a different set of numbers, and those numbers tell the opposite story. Let us walk through what a VLCC voyage through Hormuz actually costs right now. Start with the basics. Bunker fuel for a round trip, crew costs, port fees, canal dues, call it $15,000 to $20,000 per day in normal operating expenses. Against $400,000 in daily earnings, that is almost irrelevant. The margin looks obscene. But then you get to the new line item, war risk insurance. Before the crisis, war risk premiums for Gulf voyages ran at roughly 0.1% of a vessel's hull value. On a $250 to $300 million VLCC, that is $250,000 to $300,000, painful but manageable when spread across a voyage. Now, starting around the 5th of March, major marine insurers, including Guard, Skuld, and London-based underwriters, began either canceling war risk cover for parts of the Persian Gulf entirely, or raising premiums by an order of magnitude. Some rates jumped by more than 1,000% overnight. The new war risk premium sits at roughly 1 to 3% of hull value. Do the math. On a $300 million VLCC, that is $3 to $9 million for a single transit. One round trip. First, you lose the war risk cover. Next, your hull and machinery policy voids without it. Then your P&I club, the mutual insurer covering third-party liability, pulls back too. When you add those expenses together, a voyage that looks like it earns $400,000 a day can swing from profit to catastrophic loss inside 48 hours. And that's before anyone fires a missile. Now, here is what most people do not know about who actually controls this market. The global Very Large Crude Carrier fleet numbers around 800 to 850 vessels. But that fleet is split into two very different worlds. Around 20 to 23% of the fleet, roughly 170 to 200 ships, already operate in what the industry calls the shadow fleet. These are older, often uninsured or underinsured vessels, operating outside Western sanctions frameworks. They move Russian, Iranian, and Venezuelan crude without Lloyd's of London cover. without Western protection and indemnity clubs, and without the compliance paperwork that mainstream charterers demand. The shadow fleet does not care about war risk insurance suspensions. It was already operating without conventional cover. That leaves the compliant Western-insured VLCC pool, the ships that BP, Shell, major Asian refiners, and Japanese trading houses actually want to charter. And right now, up to 8% of that pool is effectively immobilized, stranded in or around the Gulf, trapped by a brutal catch-22. They cannot exit the high-risk zone without valid war risk cover, and they cannot get valid war risk cover because underwriters have pulled capacity from the region entirely. Analysts are describing these fleets as frozen, not by Iranian guns, by a clause in an insurance contract. The dominant names in compliant tanker ownership, Frontline, Euronav, and DHT holdings, are watching their stock prices and spot rate indices explode on paper, while their operations teams field daily calls from underwriters pulling back from the Gulf. These are public companies with shareholders expecting quarterly results. They can see a $436,000 day rate on the screen. They just cannot sail to collect it. But here is where the story gets more complicated, because the insurance market did not panic without reason. Since late February, Iran and its proxies have attacked more than a dozen commercial vessels in and around the Strait of Hormuz and the Gulf of Oman. These are not warning shots or near misses. Ships have been damaged, crews have been evacuated. At least one vessel has been assessed as a constructive total loss, meaning the cost of repair exceeds its insured value. Iran has publicly stated that not a single liter of oil destined for the United States, Israel, or their allies will pass through Hormuz unchallenged. That is not a threat from an anonymous proxy. That is a direct statement of policy from a state actor with anti-ship missiles, sea mines, and a navy of fast attack craft operating in waters that are, at their narrowest, barely wider than the English Channel. Modern anti-ship missiles travel at speeds that give a tanker crew almost no time to respond. A loaded, very large crude carrier carrying 2 million barrels of crude is not a warship. It has no countermeasures. If a missile finds it, the result is a fireball worth $300 million in steel alone, before you count the cargo, the environmental liability, and the wrongful death claims. This is incredibly dangerous, because conventional insurance structures were never priced for a concentrated cluster of high-value assets under active missile threat in a narrow choke point. Lloyd's war risk underwriters built their models around sporadic incidents, a piracy event here, a collision there, not a sustained campaign of state-sponsored maritime warfare against civilian vessels. The models broke, and when insurance models break, capacity disappears. So what does Washington do when the world's most important oil corridor turns into a shooting gallery? On the 17th and 18th of March, President Trump issued a 60-day waiver of the Jones Act, the 1920 law that normally requires cargo moving between United States ports to be carried exclusively on United States-built, United States-flagged, United States crewed, United States-owned vessels. The administration framed it as an emergency move to mitigate short-term disruptions to the oil market, allowing foreign-flagged tankers to move oil, gas, fertilizer, and coal between American ports more freely, while Hormuz remains effectively shut. At the moment of the announcement, Brent crude was approaching $110 a barrel, up sharply from around $69 just a month earlier. Average United States gasoline prices had risen by nearly $1 per gallon in the same window. But here's the interesting part. Shipping and maritime labor groups pushed back almost immediately, arguing the waiver would do almost nothing to cut pump prices. Some estimates suggest domestic Jones Act shipping contributes less than 1 cent per gallon to United States gasoline costs. The Jones Act waiver is a political gesture, visible, newsworthy, easy to explain to voters, and it solves almost none of the actual problem. The actual problem is 33 kilometers wide and sits between Oman and Iran. What the waiver does reveal is how deeply this tanker crisis has now penetrated domestic United States politics. This isn't an abstract shipping story anymore. It's a gas price story. It's a cost of living story. and it has a 60-day clock attached to it. So, what happens next? And who actually wins in a market this distorted? The shadow fleet is the obvious short-term beneficiary. Operators running older, non-Western insured tonnage are already moving into the vacuum left by compliant owners. They charge less than the record spot rates, but they do not carry $9 million war risk premiums either. For charterers willing to accept the compliance risk, the shadow fleet is the path of least resistance. For mainstream tanker companies, the calculus is brutal. Some will find alternative insurance structures, specialist war risk underwriters in Bermuda, Singapore, or through state-backed facilities in countries with strategic interests in keeping Gulf oil flowing. Others will simply reroute their fleets entirely, pushing more capacity into Atlantic trades, West Africa to Europe, US Gulf to Asia, around the Cape of Good Hope. Longer voyages, less risk, lower rates, but rates you can actually collect. The deeper question is, what happens to oil prices if this drags on past the summer? Analysts who have modeled a sustained Hormuz closure, even a partial one where traffic drops 30 to 40%, are pointing to Brent potentially stabilizing above $120 to $130 per barrel if no diplomatic off-ramp emerges before Q3. That is the scenario that turns a shipping crisis into a global recession catalyst. By 2026, the industry had already absorbed the shadow fleet's growth, Russia's oil rerouting after 2022, and the Red Sea disruptions of 2024 and 2025. But those were disruptions to one corridor at a time. Hormuz is different. Hormuz is the corridor. There is no detour that does not add weeks and millions in costs to every barrel of Middle Eastern crude. Whether a ceasefire or diplomatic deal changes that equation in weeks or months, nobody honestly knows. The battle is still being fought. Next time you stop at a gas pump and wince at the price, remember, somewhere in the Gulf of Oman, a $300 million tanker is sitting at anchor, fully loaded, earning nothing because the one document it needs to move does not exist anymore. Like and subscribe for more.